hope you guys are having a great day. Today we're talking about all this fuss about bond rates going up and why is it very crucial that everybody should be aware of this and they should be planning ahead. At this point, I've been on a market recession watch for almost a week now, and there is definitely going to be some recession going to happen, right? Because bond rates, and I'll explain to you guys why bond rates are very important, playing a role in this, because both bond market and your stock market competes with each other, okay? You cannot have both of them blooming unless you go through a recession and everything gets equalized, and then you could bring both of them back up. But there is no way to not affect one or the other, when you're trying to bring everything into equilibrium, okay? So before I get into the video and explain to you why there's a problem and we should all be watching for good stocks, every stock is going to be on discount price, hopefully starting Tuesday, okay? So let's get into it. Before I get into the video, please, if you're not subscribed to the channel, do subscribe to the channel. I release video every day. The objective of the channel is to build our wealth and find all these weak points where we could get in and hopefully stay there for a while and make our money and maybe double or triple our profits. Let's get right into it, okay? I had a meeting on the 14th I think it was the 14th of this month. Now, after that, if you see the last 5 days, the market has steadily went down from 14,124 to 13,548. That's a significant drop. Now, the reason this is because Fed talked about whatever, meeting minutes came out, and they're discussing about, potentially raising 50 bips, increase on the rates for the bond market, and I'll explain to you why that is important. And that 50 bips, it's not significant. However, they are speculating that there is going to be 6 to 9 more meetings that's going to happen, and those meetings actually going to increase the rates, okay? And there was Reuters has this news out from yesterday that a lot of different investment banks are already speculating, like JP Morgan raised its Fed's call to 725 bips rate. So now what JP Morgan is saying, that we think that Fed is going to have 7 meetings and it's going to increase the rates by 25. That's 1.75 bips in total, okay? Now, and JP Morgan is saying it's 25. Morgan Stanley is saying it's going to be 25 bips hike, what else? UBS is saying 150 bips overall for this year. BNP is saying it's 25, 6 times 6, same thing as what the Morgan Stanley was saying, 150 bips. That's for the city. Credit Suisse, Susie is saying 50 bips increase, 175 for this year. Okay. So Goldman Sachs is also saying the same thing, 25 bips rate hike at each remaining federal. Okay. So what they're anticipating is 175 to 2% increase in the yields. Now, I'll explain to you why that is important, okay? So let's understand the bips first. What are bips, okay? 1%, it's 0.01%. 10 is 10%. 50 is 5% of the 100, okay? So now, if they raise the yields, and what are the yields currently? Where they're giving out the money, okay? Why this is important? So right now, if you were to buy a treasury bond, which is not available to people like you and I. This is more available to the big dogs, like big investment firms and things like that. So 1 month a U.S. Treasury bond giving 0.03% yield, which is the return on investment, meaning like you lend the money, you buy the bond, you're giving the money to the government. You're buying that bond, and they're going to give you the money back on the maturity date, and they're also going to give you that 3%. Profit on that return on investment, right? So you have US 3 months, that's 0.36 yield. And again, I don't have the coupons rate on these. So coupons rate is basically nothing but they will pay you every day or every month or whatever the coupon rate they're applying. Every month they will pay you some interest on that. Yield is your overall return on that bond, okay? So you're lending money to the government, and the reason they're raising the rates is because they want people to take the money out of the stock market. All these big dogs like Apple, Google, Microsoft, all these big dogs, right? They want to take the money out of the stock market, which is very volatile, and give them the guaranteed money on their return, okay? So, for example, look at this right here. And again, the rates has not increased yet, okay? Now, look at the 30-year bond, okay? They're giving 2.2 to 4% yield on this bond. And again, I don't have the coupons rate, and that's a different story. Coupon rates is a little bit of interest that they give you here and there, just to keep you, happy on a monthly basis. Okay, so yield is if somebody was to put down 100,000 right now and give government that money, let's say, and that money is when it matures, they're gonna give them 2.42%. Okay, now that's guaranteed money. Okay, and of course it's gonna have a coupon rate. What's it gonna do is they're gonna increase that rate by 2 bips, which is 2%. So let's say if this 30 years is 2.42 right now, it's gonna go to, let's say, almost 3.95%. Okay, there is no way you have a rate this good on a bond. Somebody's going to invest that money in stocks where it's very volatile. You could, not really guaranteed returns, and not take the guaranteed returns when bonds offer that guaranteed return. And this rates, and the rates are that good. Okay. Now, so basically, then what's going on with this, right? Where do we stand here now, right? So looking at the market, I believe what I'm trying to find is I'm trying to find good stocks. Okay. At this point, we're looking at good companies, that essentially are having good earnings, but the share is going down. The only reason it's going to happen that they're going to start going down is because of the uncertainty here of the rates. Like, a lot of investors will take out the money because they know once the rates are going to go up, people will take out the money. Like, big dogs will take out their money from the market. When they do take out the money from the market, a lot of a ripple effect happens. A lot of domino effects happen. People get panicked and they take the money out as well. So this big dog's already taking out the monies from the stock market, waiting for what the Fed is going to do. If the Fed raises those interest rates for the bonds, rest assured your market will collapse. It will go into recession. It has to go into recession. There is no other way around it. There's a lot of analysts that are saying that even that 2% is not enough to get us back into the inflation rate of 2 to 3% or 4%. So even though it's not that good, but if they do increase those rates and people take the money out of stock market, rest assured we're looking at some level of recession in next few weeks. So just keep an eye out, and I will be making videos on different stocks that we could purchase and sort of on a discounted rate. And when the market, when the market goes into recession and the builds back up, you'll have an equilibrium at that point, and you'll have true value to your market, and it won't be pumped up by the government. Then that'll be a good time. Then we can see our returns on our stocks. Okay, so just keep an eye out. I just my quick video on this and explain to you guys what the what this fuss is about with bonds rates increasing and why is it affecting the stock market. Hope you guys liked this video. If you do like this video, please do subscribe to this channel, and I'll be making more videos on the stocks as well.